Welcome to Dugoscopy TV. Today we're looking at the current wave of buying European ETFs. Joining me to discuss is a founding partner of Argos Investment Managers, Philip Best. Welcome, Philip.
Thank you very much.
So the current wave of buying up European ETFs is tending to drive up the big and liquid stocks rather than the less well-known names. So how is this affecting actively managed funds?
Yeah, well, as you know, there's been this big shift going on between passive investing and active investing, with very, very substantial money flows starting to go into passive investing, which of course is mostly via ETFs. And at the back end of last year, we saw some figures that showed that in Europe alone, there had been $63 billion worth of money flowing into European ETFs, and we haven't got the figures for the beginning of this year yet, but I think it's going to be much higher than that. So the trend is continuing. And if we look at this graph, for example, we can see this is the US. It's quite simply the Russell 2000, which is a small cap index in the US, compared to the S&P 500, and we can see very clearly that the two more or less have been tracking each other. Which is because, you know, the money flows have been pretty evenly distributed between the two, and there's certainly a bit of passive buying as well. There would be passive buying in the Russell 2000, but there would have been passive buying in the S&P 500 as well. But if we look at Europe, the story is very substantially different, because here we have, in Europe, the large cap stocks up about 12.5%. As you can see from the performance of the Stock 600 index, whilst we have the small and micro cap stocks up much less. You can see the MSCI European Micro Cap Index there is up 2.5%. So that's a 10% differential between the performance of the large cap index and the small cap index. And you know, I've just selected those ones, but you should see the same thing with other indices as well. Now, why is that? Well, it's coming back to what I was saying, which was this kind of, I hesitate to say it, but like a wall of money coming into Europe through ETFs, which by and large will buy the large and liquid stocks.
A wall of money is quite terrifying imagery, but ETFs seem to be the chosen way of playing European quantitative easing, but it means buying the stocks that are already performed. So what risks are involved here? Well,
I mean, it's a really interesting question, because if we look back to '99, when, you know, obviously everybody was rushing into the same sort of tech-related stocks or whatever, these stocks were getting bigger and bigger, and people were buying them more and more. And what happens with an ETF is that, you know, if you've got a constituent of the ETF, a stock that does very well, what the ETF then has to do is to buy more of that stock. So the next person in is going to be buying even more of that stock that's already done very, very well. So what it'll tend to do is to accentuate the performance of the stocks that have already performed, with the reverse effect for the stocks that haven't performed. And that is until things go wrong, when that sort of bubble could deflate in a very, very sort of uncomfortable sort of way. So basically, my argument, and I'm selling my own book here a bit, but you know, as an active manager, I would say the market is indiscriminately buying the large caps, like you say, as a way of playing QE in Europe. And what I'm saying is that, you know, this 10% underperformance by small cap stocks is leaving substantial catch-up potential, and leaving a bunch of stocks that are just not getting much attention.
Let's look to the euro. How has the slump in the currency reshaped the landscape for ETFs in the region?
I'm not sure that it's. I wouldn't say it's reshaped the landscape terribly for the ETFs themselves. But what I would say is that from a competitive point of view, it's good news for Europe. I mean, that's clear. You know, the average European company tends to be very international. You've got something between a third and a half of revenues coming from outside the Eurozone. Plus, one's got to bear in mind that a lot of these companies' competitors are based in dollars or yen, and either way, a weakening of the euro is great news from a competitive point of view. So you stack that together with the recent fall in the oil price, and you've got a substantial competitive advantage in Europe, which is coming through at the moment. So I think it's very interesting.
It does sound very interesting. Thank you so much for your time today, Philip. It's been a pleasure speaking with you.
Thank you very much.
That's all from Philip and myself for now. Thanks for tuning in, and remember to keep clicking back to Dukascopy TV. Bye for now.